It does seem that the market is reading this ceasefire wrongly. It is not de-escalation.
Yeah, I think the market has been a little bit complacent here. When you look at sort of the reaction to the ceasefire, yes, the temperatures have cooled down a little bit. But I think the bigger implication is, how do you think about energy prices, and how do you think about the flow of energy from here on out? Because realistically, even if you started today and you started, everything sort of magically restarted, you magically started seeing the flow of energy coming back through. It's a couple of months to work your way through just the logistics of getting all those freighters back through. I mean, you're still digesting a month ago the last freighters that would have left, the Strait of Hormuz that would have been arriving in Europe into Asia and things along those lines. We're not even actually seeing the physical disruption from that yet. And then on top of that, you've had destruction and impairment of some of these assets within the Middle East as well. So you have Qatar, was hit, and that major natural gas facility. That could be up to a 5-year process to get that up and running back to full capacity. You talk about Iraq, because they haven't been able to get a lot of their energy out. That's 4 million barrels a day. They've shut in about 70% of their production. And then even after the ceasefire was announced, you had drone strikes that hit the East-West pipeline from Saudi Arabia, which is the main point that they were using to sort of get oil out, even after the strait was hit. That pumping facility was slowed down. And then Fujairah as well in the UAE, that facility was hit as well. So I think the market is taking this a little bit too lightly. If you think of the grand scheme, you had $60 oil before we went into this crisis. That was pricing in a surplus of energy supply. What we can see now is that surplus is gone. So at the very least, you're looking at a balanced market, probably closer to 80. And then each day that this ticks on, you're looking at energy prices going higher from here.
It's not just mispricing in terms of the energy market. It's also elsewhere. If you take a look at the stock market right now, where are you seeing the biggest mispricings?
Yeah, so there's a couple of different places. Obviously, within energy, some of the stocks have been trading off a little bit recently on some of this hope that there's an off ramp here. We think a lot of the cyclical companies, even before you came into this Iran conflict, were priced to perfection. People were assuming there was going to be some sort of economic reacceleration because of deregulation and things along those lines. And you had companies like Caterpillar, John Deere at 30 times earnings. You had GE at 45 times earnings. You had like a Goldman Sachs from a banking perspective at 2.6 times book value. A lot of the European banks were trading at 1.5 to 2 times book. You were priced to perfection. You were assuming that the best case scenario was going to come through. And that may have been true before a lot of this happened, but the market wasn't ready for anything less than perfect. And that was the argument that we were making internally at GQG, was not necessarily that we were expecting an armed conflict to flare up within the Middle East, was that the market was just not pricing anything less than spectacular. And I think we're still trying to work our way through that now. And the market's kind of trying to play this V-shape, Liberation Day rebound. And I think the physical implications are just a little bit more difficult to deal with than what the market is giving it credit for.
What's also been interesting is earnings. We've seen very little earnings revisions to the negative. I'm just wondering whether we're in for a huge surprise when it comes to those revisions later on.
Well, energy is one of the biggest, fiscal inputs, from a stimulus perspective. If you have cheap energy, which we have had for a number of years now, but it's also going to be a fairly large fiscal drag on the other side. You think about even by other products that are coming out of the Middle East. Think about helium. Helium is a major production component that goes into semiconductors. And we're not seeing a whole lot of helium coming out through the Strait of Hormuz because that was a byproduct of what was being produced in Qatar. You think about energy inputs in some of these other countries as well. Natural gas is a very needed commodity for production within a lot of parts of Asia. You think of like Singapore, for example, 95% of Singapore's power production comes from natural gas, and they don't have a whole lot of storage. Korea is somewhere in the neighborhood of, a quarter of their energy production comes from there. Countries like Thailand are like 40 to 50%, Hong Kong as well. So these are material things that you have to deal with. And if you're not getting this energy flow and it's going to be materially impaired, that's going to raise the costs for everything. And you're going to start seeing some slowdowns happening on the back end. So I think this is something that the markets are going to have to continue to contend with and eventually have to price in, and earnings will have to come down.
Right. So, Brian, how do you position? I mean, how do you position to capitalize on the opportunities when they come?
So there's a couple of different things that you can think about. Number one, what we thought was interesting, even sort of observationally last year coming into this year, is boring was on a discount. And so things that were perceived as a little bit slower growing, a little bit sleepier, more boring, things like utilities, things like staples, things like large pharma companies, if you think about the European context, or utilities, power utilities, developed regulated utilities, tend to grow a little bit slower, but you're still getting, call it 6 to 8% EPS growth. In some cases, a little bit even faster than that. Getting a couple hundred basis points of dividend yields. You're not paying an egregious multiple. Those things now become more in focus because they should hold up substantially better during these types of environments. I think energy is another one. People are very quick to sort of call like, okay, well, energy had a little bit of a movement on a year-to-date basis, so therefore we want to sell into any sort of strength. Again, as I mentioned before, the situation that we see in the Strait of Hormuz, you've taken out that surplus. So now your baseline of where the bottom of that energy pricing is going to come through, even if this thing ends tomorrow, is probably closer to $80 a barrel. And if ExxonMobil can make, on an average energy price through 2030, the end of the decade, if they can make double-digit EPS on an average energy price of $60 a barrel, what can they do when energy is sitting closer to 80, let alone at 95 or 100 where we're sitting right now? So I think those are some areas that become extremely interesting, especially at these level of free cash flow yields and the dividends that you're getting off of these businesses coming through. They might be the only areas that actually work well if you get into a true energy shock type of scenario.
So, Brian, when all these risks are being priced in properly, what kind of correction might we see, for example, in the S&P?
Yeah, so the S&P is still baking in. Actually, some folks have even increased some of their estimates from an S&P 500 standpoint. I think you can see some fairly material downside, from an S&P estimate standpoint. And although multiples have come in a little bit, largely driven by some of that tech rotation that you saw to some of those quote unquote halo assets, those hard asset, low obsolescence risk is kind of a phrase that folks have coined. I think that you still see some downside pressure from an earnings perspective. The additional thing that I think people maybe aren't necessarily connecting the dots on is if you think about where does a lot of the funding from the technology side actually come from? So if you're concerned about an AI bubble at all, where does a lot of that funding come from? A lot of it is Middle Eastern investors. And if you've seen that has tightened up, and those investors haven't necessarily, opened up to, putting more money into private equity, private capital, or investing in data centers or investing in AI, and that's where a lot of those deep-pocketed sort of flows were going to, that could create a problem even on the U.S. technology side of things. And what's interesting there is we've already heard and seen some cases where folks have enacted force majeure, and they've actually pulled their investment funds back, in these types of scenarios. So could we actually see a slowdown in that capital cycle accelerate what might be the bubble burst on the AI side of things? We haven't even mentioned the fact that if energy is actually driving interest rates and inflation higher, that is the very first thing that kills an economic cycle or a tech cycle as well, when you already have some questions about how much AI CapEx spending is actually going to yield from a return standpoint. So again, those are some of the things that we're concerned about, and I think the market has just been extremely complacent about pricing some of these risks in.
So you're essentially saying that this Iran war could lead to the AI bubble bursting, but how might that play out? I mean, some companies are less exposed to that than others. Would it be, the big players versus the smaller ones, like the ones we're seeing in Asia?
So a couple of things we've already heard is some of the smaller semiconductor manufacturers have seen some delays or been communicated some delays. So you're shifting around some supply there. But also if you're getting a delay in sort of when that CapEx is actually being distributed against from a CapEx perspective, from a hyperscaler perspective, does that slow down when that comes through? Again, that higher cost of capital, you have to start assessing, okay, well, if I have a higher borrowing cost and a lot of these hyperscalers are pushing more into using debt financing to fund a lot of their CapEx demands going forward, that makes it even more untenable for them to go down that process. Do investors start penalizing them? And then on the other side of things, if you look at some of these other areas that have been a little bit, I guess, beaten up, and a little bit overlooked, like regulated utilities, like these consumer staples names. They may end up being a lot less bad than sort of the slowdown that you may get in a capex cycle from an AI perspective. Let's not forget that we really haven't even monetized AI in a really big way yet. You're only
Right.
talking about 10, 20, $30 billion of revenue against $1 trillion almost in spending on capex that's been sort of promised here or even sunk into the ground.
Do you agree, Brian, that the likes of Microsoft, Alphabet, Amazon are more exposed when it comes to, the shifting financial landscape versus the likes of your OpenAI, Anthropic?
So I would argue that there is exposure on both sides because if you think about some of those frontier model companies like the Anthropics, the OpenAIs, a lot, again, those funding rounds that they're getting from, they're going to Middle Eastern sovereigns and things like that to source some of that cash flow. And there's a lot of capex intensity there. But even if you mention, an Alphabet or like a Meta, what are the basis of their revenues? It's actually advertising. And people forget that advertising is actually a very cyclical business. So if you're going into maybe a little bit of a downturn or a slowdown, one of the areas that companies, consumer products companies, things like that, will cut down in terms of their budget is going to be on the advertising side of things. So we actually, and you saw a little bit of this towards the end of 2021, now that these advertising business models have matured, you saw a little bit of a slowdown in advertising actually having a pretty material impact on their earnings. And again, this is against a situation where they're already spending well beyond their free cash flow. The free cash flow is essentially gone, and they're raising debt on the other side of this. So I think this could have a material impact to the downside.
So might we see cracks in the financial system on the back of that? Given the fact that we're seeing this massive capex and the market's been absorbing all this money.
So from a financial system standpoint, again, we were a little bit more nervous just on the fact that people had priced in an optimal scenario. As I mentioned earlier, like a Goldman Sachs was sitting there at 2.5 times book value, sort of structural highs. You have to think if some of these things, these capital cycles start to flow down, M&A activity has to slow down, investment banking activity maybe starts to slow down a little bit, maybe the IPO process starts to slow down. It does. I'm not saying that this necessarily has to happen now, but this feels very late in the cycle. And then you have sort of this shock that is sitting on the other side of things that potentially slows things down a little bit further. Again, our argument isn't necessarily that we think all of this necessarily happens tomorrow. Our argument is that the market is already priced in that we move on beyond this, and you're not getting paid for that. You're not getting paid for that. So what you are getting potentially paid for is anything less than that optimal scenario. The market's not ready for that. And we like our positioning in that type of a scenario.
We've been talking about exposure to the Iran war in one country, one market. Hugely exposed is, in fact, India, but you're still bullish. Why is that?
So what's interesting about India, I mentioned, some of the power exposures and sort of the energy exposures of some of the other countries where they're getting their natural gas from and how much of that is used. What is super interesting about India is a couple of things. Number one, their power production, 70% of their utility power production, their electricity generation, it actually comes from coal. And India has a lot of coal. And they have the ability to continue to sort of process and get more of that. So from an actual utility and electricity generation standpoint, if 70%, almost 3/4 of that power production is coming from coal, it's not as big of a deal for them to sort of absorb that. A lot of the rest of it, by the way, comes from green energy, things like wind power and solar. So very minimal. You're talking like 3-ish% comes from actual natural gas. Now, they are a net importer of energy, so they do take in crude oil, and they do use that for petrol and diesel and things along those lines, and that will be a bit of a drag for them. The one thing I would say about that, though, is India has some of the most complex and advanced refineries in the entire world, and they're able to take crude flow from a variety of different sources. That's not true of everywhere in terms of the refining capacity, in terms of the mismatch that is out in some of other locations. But India could take Russian crude, which has now been freed up. At least the stuff on the water has been freed up from sanctions. Some of the Iranian stuff that has been freed up. Venezuelan heavy sour crude has been freed up. So you're seeing that India has options in terms of these other things. And then the names that we own are much more on the infrastructure and utility side of things, which are the types of names that you would rather own during some of these periods of volatility anyway.